Hello, and welcome to Navigating Seasonal Cycles with Jake Bernstein. The information provided in this episode is for educational purposes only. There is a risk of loss in all trading and investing. The results shown are hypothetical and should not be construed as investment advice. And now, over to you, Jake.
Greetings once again, everyone. This is Jake Bernstein for the Foundation for the Study of Cycles with my seasonal recording for this week. I would say that this is not actually seasonal, but it's a variation on the theme of seasonals, and as always, pardon the voice, I'll try to do better. The methodology we're going to use today is based on seasonality, but is also based on a pattern. I repeat that I want to do this for a very specific reason. I would like to share with you some of the tools that I've used in my 50-year career plus to achieve success, not only in the markets, but in investing as well. So whether I've been using the long-term real estate cycle or the shorter-term cycles, they're all part of the same work. Today's talk is about a pattern and partially about a seasonal. And remember this, although all cycles are patterns, not all patterns are cycles. Think about that for a moment. There may be a pattern that does not repeat regularly over time. It would be simply a pattern. However, a cycle is based on the idea that it repeats over time, more or less the same length of time, but not necessarily symmetrical. Let me begin with this. We've talked considerably about the seasonality in stock index futures, and I've indicated to you that October, November, December historically have been the most predictably bullish periods of time of the entire year. That is true, and here we are, October the 1st, getting ready for the most bullishly predictable time of the year. And remember that in the scheme of things, it's not a guarantee. Even though that tendency may be 70 to 80% accurate for many years, it does not repeat every year. Therefore, in my work, the cyclical tendency of stocks to go up October, November, and December is a pattern that is not perfect, but within the scheme of things, I call it a setup. A setup requires a trigger, and there are many different triggers that can be used for timing. So call a setup, a pattern, and a trigger, timing. And then, of course, comes the most important part of the equation, how you manage the risk and maximize the reward. Remember that my intent here is purely educational. I'm not interested in getting paid for this. I'm not interested in paying anyone to let me do this. It's purely educational, and the best thing you can do for me is remember this. As they say in French, plus ça change, plus ça même chose. The more things change, the more they stay the same. And as long as things stay the same, you can apply triggers to patterns. You can apply triggers to setups and hopefully use cycles in a pragmatic fashion. Over the years, I've met some people that are dyed in the wool based on theory and based on expectations. What I mean is this. They're firm believers in Elliott wave or in cycles. I'm not a firm believer. I'm a believer in the pattern, a believer in the pragmatic application of patterns. Therefore, use this work to your advantage and make cycles pay for the work that you do in studying them. Let's begin with this pattern and this cycle. This is the chart of S&P stock index futures covering the years 1982 through 2025. And in the past is a composite chart. I've taken every year of September S&P futures and made the high of the year 100, the low of the year 0. So it's a normalized seasonal chart. It shows you what typically happens. And think about this. This chart was made well before this year started, and yet it predicted almost exactly what's happening now. And as you know, we've made a very strong move in stocks until the summer. We sold off and we're making a secondary peak right now, as it shows in the chart. But we can go further with this. We can look at a seasonal chart for the month of December, which will give us an idea of what's going to happen in terms of the setup And whether the trigger is there or not, time will tell. So let's change this chart. Now here we go. Here we go to the bottom of the chart and let's look at the time scale. This is where we are now. Let me show you. At the beginning of October, right over here. So what have we got? And remember, as I've told you in the past, September has been generally unpredictable, but has had a lower tendency. Moving into October, November, December, we see a very strong move up. In fact, the move in terms of magnitude from the beginning of October until the first week of December covers the vast majority of the move of the entire year. So be prepared for this. And this is super important to me. Remember, this is not a guarantee. It's a forecast. It's a setup that needs a trigger. Looking at these green arrows, what do they mean? These green arrows are very strong weeks up in terms of statistical probability. So you have the first 3 weeks of October, the first 2 weeks of November, and the last week of November, first week of December. Those of you who are fundamentalists will look around and say, but look at the geopolitical situation. It's a mess. You've got North Korean troops in the fight between Poland and Russia, between Ukraine and Russia. You've got the government shutdown today. You've got all these threats of war going on throughout the world. You've got the president threatening to send troops into cities for training purposes. If someone told you the news that is happening today, if they told that to you 5 years ago, you would have said that could never happen and it would make the markets collapse. And yet, here we are with gold at all-time highs, silver moving sharply higher, sometimes $1 a day, the stock market moving higher. It's unbelievable in terms of the fundamentals, because the fundamentals in terms of geopolitics are worse than they have been in many years. So either you're devoted to cycles and what they predict, or you're a fundamentalist trying to grapple with reality. Speaking of reality, those of you who are familiar with my work, who've attended my webinars and seminars throughout the world for the last half century, are familiar with what I've called my birthday trade. My birthday trade. Yes, let's talk about that. My birthday trade for many years was based on the idea that usually by September 20th, which is my birthday, the gold market has rewarded me with a handsome profit because gold has had a tendency to go higher around my birthday. In fact, beginning before my birthday and ending after my birthday, which puts my birthday trade, September 20th, in perfect situation. Let me show you something that you might find interesting, and then we'll move on to what I really wanted to talk about today. And by the way, anytime you want to write me, write the foundation, and they'll be glad to have me answer your questions. I'm going to go down here and pick the gold market, like so. I'm going to look at a composite seasonal chart of gold. And we're going to look at the December contract for starters. In fact, let's go a little bit further back. Let's look at the September contract. Okay, so it showed me December. Let's take a look at the chart. And what does it show? One moment, please. Come right down to it. And look at, we're talking about a significant number of years. So here is my birthday. Here's my birthday trade. And what does it show for the next 2 weeks? If the seasonal is right, within the next 10 days, 15 days, this dynamic, incredible, record-breaking gold market, which was predicted by me in the annual forecast for the foundation, this incredible bull market is likely to come to a screeching halt, at least temporarily, and to be followed by a massive correction down. And remember, that's just a forecast. It's a setup. It needs a trigger. But let's see what happens. But what I really wanted to talk about today was a pattern. Remember what I said. Not all cycles are patterns. Not all patterns are cycles. In fact, patterns are not cycles at all. They're simply patterns. They could repeat at any time. A cycle, however, is a pattern that repeats regularly over time. So please note the difference. In order to look at that pattern, I'm going to go to a chart of the Dow Jones and explain the pattern to you. If you've seen me do this before, that's all right. A little repetition is a good thing. Okay, so now that we've seen these seasonal charts on the futures, we know that October, November, December have been historically strong. Let's switch to another pattern. We're going to switch to a pattern based on years numbered 5. Many people have talked about the years numbered 5 pattern, but really don't understand how to use it. I will show you how to use it. So when we talk about years numbered 5, example, 2025, 2015, 2005, 1995, etc. Very simple. I'm showing here a chart of the Dow Jones Industrial Average monthly, January, February, March, April, and so forth. Open, high, low, and close. If we take a look at the chart, we can see that the January high was approximately 45,054.36. What we need to see in order to trigger this pattern is 2 successive monthly closes above the January high. Right over here, where my pointer is, we had a January high close. We had a close above the January high, right over here. So that would be the first one. The second one is in process, right over here. And we're waiting. Waiting for what? We're waiting for the month to end. This bar has not been completed yet. Therefore, we have not had 2 consecutive monthly closes above the January high. We're waiting. Let me show you a little history here. So just bear with me for a moment. Let's go back to the previous year ended in number 5. That would be 2015. So don't make to make you dizzy, but let's go back a little bit in time, like so, to 2015. So here we are, 2015, 2016. I'm gonna go back and make it a little bit bigger so you can see it better. Here we are. So this here is January 2015. This over here is December 2015. If I take this tool right over here and measure January high, it's a very mechanical process. So what we're doing here is we're measuring the January high, 2015, was right here where the red line is. This was the first monthly close above the January high, but as you can see, we never had 2 successive monthly closes above the January high. Therefore, we had a setup pattern, but no trigger. Remember, this is only a buy pattern, so we're not looking on the sell side, just the buy side. No trigger, no trade, no setup, nothing. Let's go back to 2005. So please watch closely, because the forecast is very simple. If we get 2 successive monthly closes above the January high in a year numbered 5, ending in 5, we tend to get a strong rally thereafter. So let's take a look at the previous year numbered 5, and that was 2005. So let's go back in time. Try not to get dizzy. And if you think I feel bad, I don't. I sound bad, but I feel great. Here we go. 2005, right over here. So this is January 2005, like so. Let me mark it for you. And this is December 2005, right over here. And let's mark the January high. And you see this is really so easy, even a computer can do it. Even artificial intelligence can do this. So here we go. What do we have? Right over here. Nada, 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 nothing. Fine, no problem. Let's go back to the previous year, numbered 5, 1995. Here's 1995, right over here. Mark the first month, January. I'm going to mark December. Now, isn't that interesting? What happened? Well, here's what happened. I'm going to mark the high of the year. As you can see, this is a totally mechanical process. Right over here is January. I'm going to mark it for you. What happened? Immediately. February and March. Your buy trigger was here. And what happened after that? You had one heck of a rally. I think we can even measure it in terms of percent. Let me show it to you. Your buy trigger was right over here. And you moved to the end of the year, like so. So that by December, we had rallied approximately 21%. Let's go back in time now. So we're going to go to previous year, number 5, 1985. So what happened in 1985? Let's find out. This is January 1985. Let's mark it for you. And this is December 1985. And what happened? Let's find out. It's very simple, as you can see, because if I can do it, anybody can. Here we go. This is the January high. And again, this is approximate. One, two successive months closing above the January high. The size of the move, I'll show you from year to year. Here's the trigger right over here. Over the next few months, you had a second opportunity to do what you're supposed to do. And here's the result right over here. A mere 15%. So let's go back to 1975. And I hope you're not getting too bored with this pattern. 1975, right over here. Let me mark it for you. And remember, this is a buy pattern only. There we go. And I think it's pretty obvious, but we'll put it in there anyway. January high. Now we're gonna have to wait around until 2035. I probably won't be here, but I hope you remember this pattern. 2 consecutive months close above the January high. And the size of the move. Let's do that right over here. And it did go higher, but it did give some back before the end of the year. But nonetheless, another move of about 7%, 10%, right over there. So there we go. And we'll look at one more and then, well, let's see. Well, I think we have some time left. So let's go ahead and go to 1965. And here's 65. Let's mark it. January. Right over here. And remember, it's a pattern, it's not a cycle. So there's the year of 1965. And here is our 2 consecutive closes. Let's mark it first. So what happened? Close number one, close number two, then a big pullback. However, by the end of the year, it had regained everything it lost, and then some. So how much? I'll show you. 2 consecutive months closed above the January high. And by the end of the year, after a drawdown, 5%, not bad. Let's just do one more, 1955. So you can see that again, you don't need to draw it in, but I will do that anyway for you. There's the January high. Remember, we're using the Dow Jones Industrial Average. Here's our trigger. 1, 2, and to the end of the year, how much did it gain? So there was a nice little 15% move. And you haven't even seen the best ones yet because there are more. Let me go back to 45. I think you get the picture, right? No puns intended. And remember, you also have to manage risk. 45. And let me mark 45 for you. I think you can already see what happened. And what do we see? I'll show you. This is an amazingly simple pattern, which is not perfect, which may not have sufficient number of repetitions to make statisticians happy, but it is what it is. There's 1 month above, 2 consecutive months above. Let's put it in terms of magnitude now. So relevant to this year. Let's talk about this year for a moment. This year, think about it. We've had one close above the January high. We're waiting for a second one. That would be October. If that happens, there's only 2 months left, November and December. And if the pattern holds true, they should be very big months. We'll see what happens. Go to the previous decade. Let's go to 1935. We're almost done. I just want you to see it all. So let's go back. And by the way, I don't take credit for discovering this. I don't know who discovered this. I think Larry Williams showed this to me many years ago, but it didn't show me a trigger. Let's go to 35. I don't even have to tell you about this one. You can figure it out, but I'm going to show it to you anyway. It's definitely not rocket science. So there's 1, 2 consecutive closings above the January high. Let's measure the size of the move. And then before my voice totally gives out on me, I will save you from listening to me. Here we go. So a mere 30%, not bad. So let me review. Seasonal tendency in gold from the second week of October is down. So watch this rally closely, even though the cycle was very perfect. There comes a time for things to end. Be careful. If you took the advice to buy gold, take some money off the table before it starts to go down. Number 2, the year-end pattern. Numbers 5, very specific, very clear. 2 consecutive monthly closes above the January high frequently leads to a very bullish move to the end of the year. Let's see what happens this time. If you have questions, send them to the foundation. If you're interested in my forecast for 2026, it's on my website, jakebernstein.com. Thank you very much, Dan. Thank you, Bill. Thank you for the foundation. Sorry to insult you with my bad voice, but I hope the information was good. Take care, everyone. Have a great end of the year.